Year and welcome to the first in our 2024 series of Professional Advisors Working Lunches brought to you today with our partner Baillie Gifford. I'm Katrina Lloyd, I'm Editor-in-Chief of Professional Advisor and I'll be your host for the next hour. The first thing you'll notice is that we're on a new platform today, StreamGo, which we hope will add to the richness of your viewing experience today. Before we get going with today's session, let me quickly run through the usual housekeeping. Your microphones and cameras are currently switched off and we'd be really grateful if you could keep it that way. This will ensure there's no background noise so the speakers can be heard more clearly. I should also inform you the session's being recorded and we'll be sending you a link to the recording within 48 hours. Do feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD and we'll be sending you proof of attendance over email within 48 hours. So now let's get on with the session. Scottish Mortgage looks to identify, own and support the world's most exceptional growth companies. And over the next hour, I'm going to be joined by Claire Shaw, who's the Investment Specialist Director with specific responsibility for Scottish Mortgage. We're going to be uncovering the characteristics of the trust that give it a unique DNA, exploring everything from Baillie Gifford's access and reputation, their investments in private companies, and their ability to provide long-term patient capital to their portfolio holdings. At the end of the session, there will be time for Q&A with Claire, and please send your questions using the Ask a Question function below the stream of the session. So just before I hand over to Claire, let me quickly run you through our learning objectives for today. At the end of this session, you're going to discover what the unique philosophy is that sits at the heart of Scottish Mortgage, why long-term structural changes in society are more powerful drivers of change and disruption than macroeconomic or geopolitical issues, and why it is rational to seek out the exceptional companies driving this change to maximise your chances for growth over decades, and why the current environment leaves room for optimism for investors willing to take a long-term patient view. So just to remind you about the questions, and please submit them for Claire today. I'd like to hand over now to Baillie Gifford's Claire Shaw for her presentation. Hello, Claire. Thanks so much for joining us today.
Thanks, Katrina. Thank you very much for having me.
I know you're just going to get your presentation set up and check we can see everything. So I'll just let you do that.
Okay. Hopefully everyone can see that on screen now. Is that coming through fine?
Yeah.
Can you see that, Kat?
I think we're there. Yes, I can see it. Yep.
Perfect.
Great.
Okay, well, firstly, good afternoon, everybody, and thank you very much for taking time out to come along and listen about Scottish Mortgage. As Katrina said, we've got an hour scheduled, so I thought it would just be helpful to outline a rough agenda of what we've got planned for that hour. I was maybe going to spend the first 10 minutes or so reflecting on the last few years against the backdrop of our philosophy and really trying to recap what exactly Scottish Mortgage is and the role it can play in your portfolio. I then want to kind of zoom in on the last couple of years, and I've detailed that part of the presentation from headwinds to tailwinds, explaining how we and probably growth investors more broadly have faced multiple headwinds, but there are good reasons to believe we're at an inflection point, and those headwinds are behind us, and we now have strong tailwinds that gives us good grounds for optimism. I'm then going to maybe delve into a couple of the big themes that we're excited about, so everything from AI to healthcare, to decarbonisation, to the digitalisation of commerce. So that's like a rough agenda of what I've got planned. So in terms of where to kick off, I decided to almost go back to the archives a little bit when I was reflecting on the period that we've just been through. And I've taken some quotes from the 2009 annual report, where Scottish Mortgage had just suffered a 40% drawdown. And we said that year that we will only abandon our contentions and our stocks when their long-run prospects have deteriorated, rather than when the dreadful mood of the markets has hurt their immediate valuations. We also stated in that same report that the survivors of this severe shock may be in dominant position for many years to come. You can see on the chart on the right-hand side there that the following 5 years, following that 40% drawdown in 2009, we delivered a near 200% return for shareholders. When companies such as Amazon, Illumina, Google, and Tencent, the survivors of that shock, delivered phenomenal returns for our shareholders. So what is the moral of the story here? Well, it's that being long-term really matters. And I always think it's helpful to go back to first principles when we're thinking about Scottish Mortgage. And Katrina alluded to it in our introduction. Scottish Mortgage has a clear purpose, which is to identify, own and support the world's most exceptional growth companies. We define our task quite narrow in terms of we're really trying to find those companies that are the big winners. What are the companies that are going to deliver those big opportunities and deliver those outlier returns? And our job is to own them for long enough without interference so that return accrues to our shareholders. So I think the key takeaway, from this kind of opening slide is that our philosophy hasn't changed. What we've said in 2009 would be equally repeatable today. We know our approach will never consistently be in favour, but we should not deviate from it to avoid short-term headwinds. And I think it's safe to say that if patient ownership of growth companies was easy, there'd be more people doing it. And I think that's why Scottish Mortgage has that distinctive DNA and why it is that we are different. I thought it would be helpful just to zoom in a little bit in terms of the last few years. And looking at this chart, it's safe to say it's been a bit of a wild ride for our shareholders since the pandemic. 2020, the year of COVID, you could see we generated exceptional returns for our shareholders. Subsequent couple of years, we saw some of that unwind. And so the natural question is this volatility behind us? We think volatility is always inevitable. In our style of investing, we think that in order to achieve those kind of exceptional returns, you're not going to have smooth performance. There's going to be bumps along the way. Getting extreme returns and smooth performance are almost mutually exclusive. But what we think characterizes the last few years as something quite different is that what you saw was this large disconnect between company share prices and their underlying fundamentals. But I think in terms of this section, I said it's probably quite interesting in terms of where we are today. I think it's safe to say that there's been what I'd call a triple whammy of headwinds that's caused us pain in the last couple of years. And I've tried to sort of just break them out here just to see in terms of where are we with these headwinds. The first one I would say is that in line with the unprecedented interest rate hikes that we saw, stocks growth stocks were severely derated. You had their valuations compressed, some in upwards of 60%. When you think about what you're reading from the Fed or from the ECB or from central banks worldwide, we think there's mounting evidence that interest rates have peaked. We're not macroeconomists, but what we do think is that kind of valuation compression on the back of the association with interest rate hikes, we think it's a headwind that is behind us and should not be a headwind, going forward. The other thing that's been against us is growth stocks and growth equities were really subject to quite severe downward revisions. And it's very, very difficult for stocks to do well when consensus estimates are being continually revised downwards. And you had that through all of 2022 and certainly in the first half of 2023. If you look at the second half of 23, and this isn't the case with all growth stocks, but for many of the ones that we look at and hold, those estimate revisions have stopped being revised downwards. And in some cases, they're actually being revised upwards. And so that's pretty exciting from that perspective as well. And then the third thing that's been against us is that kind of deceleration of growth. A number of the companies that we own were probably growing north of 100% during those pandemic years. You take the classic stay-at-home stocks, the Zooms, the food delivery companies, Moderna, Snowflake, those companies delivered, astronomical growth rates during the pandemic. Now, those growth rates have decelerated, but they haven't decelerated to zero. They're still growing at, 30 plus, 40 plus %, many of these companies. And I think why it's an interesting moment in time right now is that if you think about those combination of those three factors, the reversal of any one of them promises hope, but the potential reversal of all three is really quite exciting. And I think there's a really decent case to be made that we're at such an inflection point with those headwinds behind us. But I think what's probably more exciting is actually looking at tailwinds. Why are we excited? What's the forward-looking case from here, and what's the reasons to be optimistic? Well, again, I think there's probably three layers that we can look to here in terms of what gives us those grounds for optimism. The first one is our portfolio really does have phenomenal revenue growth underpinning it. The average revenue growth of our public companies is roughly 3 times the index. If you look at our top 10 public companies, they're growing their average revenues about 40%. The same for our private companies. The types of companies we're looking for, these aren't GDP plus growth businesses. These are the most exceptional growth companies in the world. And when you look at the numbers that they're delivering, you can see that very clearly. The second one's an interesting one, and it really relates to how adaptable companies have been in light of the changing backdrop. And so what I mean by that is, growth companies and companies more broadly have probably enjoyed a decade of cheap capital. You've gone from an era of capital abundance. You've gone from an era where, companies have had access to cash, at a very, very easy and cheap cost. And I think what we've seen in 2023 is that backdrop has changed to one of capital scarcity. And our companies have really realized that they want to be in control of their own destiny. But more than that, what they realize that this kind of growth at all costs will no longer be rewarded. It's growth with cost control that matters. That's the more favored approach. Companies do not want to be relying on external financing to fund their growth plans. They want to be using their own free cash flow and reinvesting that back into the business. And so what I think is really interesting from our point of view is, the proof's in the pudding here in terms of, if you look at the sum of the free cash flow that our companies have generated last year alone, was up over 100%. Now, as I say, why that's important is in this era of capital scarcity, being in control of your own destiny, having your own free cash flow generation is really, really important. So those are the first 2 variables. You've got robust revenue growth, and that's then supported by improving profitability and free cash flow. But then you've got this third variable, which is almost supercharging the other 2, which is these companies are underpinned by really strong structural growth drivers. Now, we've said for a very, very long time, what matters in the long run for companies is not where interest rates are, what inflation is, what GDP is. It's deep underlying structural change that generates returns. Change drives growth. And so when you look at our portfolio, the themes we're going to delve into a little bit later, what we're exposed to, whether it's artificial intelligence, decarbonization, the intersection of healthcare and technology, we see the fact that these structural growth trends do not seem to be decelerating. If anything, the opposite. There are very, very strong arguments that they are set to continue, if not be more aggressive in their growth over the coming years. So those are the 3 tailwinds that we think underpin our portfolio. And I guess the cherry on the cake is, what you're being asked to pay for this. What's the underlying valuation of our companies in the portfolio? And so just to take a multiple that people will be familiar with, if you take the average price to earnings multiple of Scottish Mortgage, it's roughly about 2 times the index. But if you look at the underlying earnings growth you're getting with that, it's between 4 and 5 times the index. So in terms of what you're paying for it, you're not actually paying for the growth embedded within our companies. And I think that's where the real excitement for us lies at this moment in time. I said I would maybe delve into some of the themes that's getting us excited right now. And I thought this would be an interesting place to start, because if you think about the digitalization of our world, it's ongoing. You can see it all around you. But I think for us, one of the things that's massively overlooked is that the biggest impacts of digitalization are not here in the UK or not in the US. They're in the places where existing offline solutions are poor, so where the impact of digitalization can be greatest. So you take Latin America, for example, digitalization here is going to be much more valuable. And we can see that in holdings like Mercado Libre, which we have, which is an online shopping platform, a payment provider, and increasingly a digital bank. It's really the center of life in Latin America. And so if you don't have access to the retail equivalent of, Tesco's or Marks and Spencer's, the impact of being able to buy millions of products at the lowest possible price on Mercado Libre isn't just better, it's revolutionary for these markets. And so if you look over the last 5 years, Mercado Libre has grown at a phenomenal rate, both in the amount of money it's transacting, the payments platform's grown tenfold, the revenues have grown tenfold, and it's really one of those companies you can see the impact it's having on a region where e-commerce penetration has been historically low. Sticking with that theme in Scottish Mortgage right now, one of our largest holdings is Pinduoduo, PDD, which is on the screen there. Pinduoduo is an e-commerce business in China, and its key to success has really been connecting factories and farmers direct with the consumer. And so why that's interesting is you're cutting out all the kind of the middlemen in the middle who all take a cut. And so Pinduoduo are able to pass those costs on, or those cost benefits, to their underlying consumers. This platform has been growing strongly for a number of years. They launched a global version of this recently. Some of you may have seen it pop up on your Instagram feeds, called Temu. But Temu is now the most downloaded app in the world last year. It went from selling 0 sales to selling $7 million a month in June. Recent estimates are now selling about $2.5 billion a month, and it's still continuing to launch in new countries. Other examples where we were really excited about for that digitalization theme is companies like Affirm in the buy now, pay later space, or Wise in the money transfer market. This is a company who really has a strapline. It's money without borders. It's helping send remittance payments home from parts of the world to other parts. And so overall, we think this theme offers a lot of promise. And you can see there in the growth numbers, the projected growth of these industries has phenomenal tailwinds behind it. The second area to come on to is healthcare. And I think when I was thinking about this, the interesting observation I think had to start with is, why are there no trillion-dollar healthcare companies right now? We have trillion-dollar companies in technology and advertising and retail, but we don't have any trillion-dollar healthcare companies. Why is that? And the reason's quite simple, is that in healthcare, the success with one drug doesn't increase the likelihood of success with the next drug. There's no increasing returns to scale. There's no economies of scale in healthcare. We think Moderna, which is our largest holding in healthcare, we think has a shot of changing this. mRNA, which is the technology they use, is essentially designing drugs on a computer. This is a fundamentally different way of drug discovery. And there's a lot to be excited about with Moderna. The cash flows that came from COVID has been deployed into advancing a large number of programs through the clinic. And I think key to the investment case that's maybe not appreciated by the market is that 90% of drugs fail in trials. And the largest proportion of those fail is for safety reasons. The molecule being put into your body has unintended consequences. With Moderna, it's the same mRNA molecule with kind of minor edits, if you like, that's used to create everything from vaccines to cancer treatments. And so I think that's what gives us excitement right now with something like a Moderna, is it is doing something differently. Other examples in the healthcare space that we're excited about would be something like 10x Genomics, which is helping increase our understanding of biology. It's allowing scientists to sequence cells one at a time, single cell sequencing, giving a much higher definition of our view of biology. Or you've got companies like Tempus Labs, our private holding, which is sequencing the tumors on cancer patients. It's now connected to half all oncologists in the US. And on the back of this data, it's enrolling patients for clinical trials and deploying AI to spot kind of gaps or recommend treatments. That's a really exciting development there. Or we have companies like Recursion Pharmaceuticals, who are basically industrializing drug discovery. This is a company who's trying to make drug discovery cheaper and faster and more efficient. But it's leveraging technology to scale that drug discovery and get treatments to patients much more quickly and quickly and cheaply than conventional approaches. So in terms of our portfolio and the areas we're excited about, we're talking about exploiting the white space in healthcare. We think there is just so much opportunity to be had. This intersection of healthcare with technology, the power of artificial intelligence and machine learning, what that can do for this space. And as I say, we think that that's going to lead to better outcomes for patients in the long term. The third theme I was just going to maybe touch on was decarbonization. This is a huge opportunity. Entire industries are looking to decarbonize to meet their climate goals and to benefit from the increasingly attractive economies of renewable energy. But I wanted to focus on one particular company in this section, which is Northvolt, which is a private company that we hold. It's a top 10 position for Scottish Mortgage right now. And they're currently the leading manufacturer of lithium-ion batteries that go into electric vehicles. And so if you just think at the highest level, the demand for batteries is huge. It's driven by that growing number of electric vehicles that's sold each year. I think something like 12 million electric vehicles were sold last year. This is expected to grow closer to 60 million by the end of the decade. And so to meet those numbers, the world is going to need many, many more batteries. But the problem the West faces, and you can see that on the chart on screen there, is about 80% of batteries are currently made in China. So there's not just a need for more batteries, but ideally there's a real need for batteries to be produced in the West. And this is a solution that Northvolt is providing. As well as providing batteries which are cleaner and greener, they're using hydroelectric power with few carbon emissions to actually develop these batteries. Because they're based in Europe and in Sweden, there is that kind of strategic element to the company as well. And what's interesting with Northvolt is you can see that in the demand for their product. Northvolt has a backlog somewhere in the region of $55 billion from companies such as Volkswagen and BMW and Volvo. And so you can see it's really coming to be, it's probably one of the most geopolitically important companies going forward. It's a strategic asset to the European OEMs, being able to source a more localized and domestic supply of these lithium-ion batteries. Oh, wrong way. But it's also about in decarbonisation, funding the next generation, I would call it. And so we've got a couple of companies in the portfolio where I would say they're on their earlier part of their journey. So we have a company, Solugen, which very simply speaking, they are looking to decarbonize the chemicals industry. The chemicals industry is probably one of the dirtiest in the world. I think it's responsible for something like 30% of all CO2 emissions. Solugen are looking at ways to try and decarbonize this industry. Climeworks is another really interesting example. This is a Swiss company who essentially are trying to suck carbon dioxide out of the air and store it underground. We had the privilege of speaking with them a few weeks ago, and the founder of Climeworks said, in 10 years' time, it's going to be as familiar seeing these carbon capture facilities as it is seeing a wind farm. That just gives you a sense of the scale of this sort of technology. But if you look at where money goes in terms of the venture capital world, where is the investment being spent? And you can see that the majority of the investment is really concentrated in transport. And probably the success of Tesla has a lot to do with this. But Tesla's only responsible for, transport's only responsible for a very small amount of emissions. There's other areas that need that attention. And Climeworks and Solugen, we think, are really interesting companies with really interesting technologies that could be fundamental in our fight against climate change. And then maybe finishing on the topic of the day, it's the topic that's in everyone's mind right now. It's the one that's getting all the column inches, which is artificial intelligence. And I think it's important to say this is not us jumping on the bandwagon. It's already, many might say, an overhyped topic. But from a Scottish Mortgage perspective, we think this is an area that's going to bring about profound change in many industries. But I think the point that we want to make here is, well, there's 2 points really, I think, that we want to pull out of AI. The first one is that this isn't us just jumping on the bandwagon. You can see that from the chart at the bottom. We've been thinking about this for a while. We've been building up exposure to a number of these companies for many, many years, even going back to ASML, first bought in 1996. So I think that's the first thing, is that this is a theme and topic that we have been researching and investing for a number of years. But the second point is that we have exposure across the entire value chain of artificial intelligence. So just to give you a sense, if you think about AI, the AI value chain, at one end of the spectrum, you've got what I'd call the picks and shovels, that this is the hardware and the chips. This is the NVIDIA. This is the most direct way of playing AI right now. And, NVIDIA has been the prime beneficiary of artificial intelligence. And you can see that in terms of the growth rates that it delivered last year. You've also got ASML in there, which is the company that makes the machines, that makes the chips. And again, the AI and the demand for chips has been a good tailwind for that company as well. If you come down the value chain, you come to the cloud. The cloud and AI have kind of separate challenges and distinct growth paths, but their development is very intertwined. If you think about ChatGPT, the platform that most people are now familiar with, it relies on the power of the host platform, Microsoft Azure. And so from a Scottish Mortgage perspective, we have AWS, Amazon Web Services, the cloud part of Amazon. And we think that AWS plays a really significant role in generative AI because it's providing that robust cloud platform that allows you to run these programs. Gen AI programs need that compute power, and that's only possible by the cloud. You then come down the kind of value chain and you have what I'd call the cloud services, or maybe a better way of framing this is, how is an enterprise, how's a corporate going to utilize AI into their business? And here we have businesses such as Snowflake and Databricks. Databricks is a private company still. But what they're essentially doing is helping companies that maybe don't have armies of AI engineers. They're helping these companies extract valuable information from their own data and gaining deeper insights. So essentially the best way to think about it is they're helping customers build their own generative AI models with their own data sets, which is held within Snowflake or Databricks' data cloud. And I think this part of the value chain is really, really interesting. You then come down to how it's being deployed in industry. And here you've got, Tesla is your classic example. Tesla is the company that calls itself, an AI company. I think Musk says, we're not a car company, we're an AI company. But you've got examples there. You've mentioned Recursion earlier on about what they're doing with using AI to industrialize drug discovery. You've got many other examples within the healthcare space. You've got companies such as, HeartFlow, which is essentially transforming the way that heart disease is diagnosed by creating a kind of personalized 3D model of your chart and then running powerful computer algorithms through that to look at how the blood flow flows through your arteries. So there's many examples we have of how AI is being deployed in everything from healthcare to the consumer world with Spotify or in transport with Tesla. And then right at the end of the value chain there, you've got companies such as Roblox, which is obviously helping create better content on its platform, or Spotify, with its AI DJ or Meta platforms, which is helping businesses try and improve that conversion and that monetization through advertising. So I think the message that we're really trying to sort of bring here is that, we're really excited about the effect that AI is going to have, not just in one part of our economy, but we think it's got profound impacts, across a range of industries. And as I say, maybe just to finish off is on the point I kind of made earlier, which is that, for us, there's a lot of noise out there. There's a lot of noise in the markets. There's a lot of noise around, interest rates, inflation and GDP. But for us, the opportunities that we have in the portfolio is about those long run structural trends that I talked about, rather than economic tailwinds. And I think that's really what gives us those grounds to be excited from here. So I think that's probably enough talking at you. And I'm very conscious that I want to leave plenty of time for questions. So with that, I'll hand it back to Katrina, and happy to take any questions that anybody has.
Hi, Claire. Thanks so much for that, for going through what's been happening with the trust and some of your thoughts there on some of those huge changes that we're seeing. Really, really interesting. Just a reminder, please do put your questions for Claire in the questions box there, and we'll try and ask them to her for the rest of the session. Claire, I have got some questions for you here, but I wondered, I'm sure some of the people listening will be familiar with Scottish Mortgage and the team there, but I wondered if it might be worth just very briefly you just giving us a sense of the investment team there and their sort of process, and especially how they work together, how they generate ideas, divide responsibilities between them.
Yeah, sure. So we're very, very fortunate in Baillie Gifford. We have a very good depth of analysts, investment researchers within Baillie Gifford. I think we have roughly now, I think about 140 from memory. I think that's the last sort of rough and ready number of investors on the investment floor. And within Scottish Mortgage more broadly, I mean, we rely on the resource of not just the people that work within Scottish Mortgage, but that broader ecosystem within Baillie Gifford. We have, however, as you would expect, we have two named managers who are the decision makers. They are the ones that make the final decision at the end of the day. So Tom Slater is the manager, Lawrence Burns is the deputy manager. Tom is also head of our North American team. So he primarily works with the US companies. Lawrence works on our international strategies, which is everything ex-US. So they're a really nice complement from that perspective. But they do feed into all the other teams within Baillie Gifford. So whether it's our health innovation team or whether it's our team in China that are, analyzing domestic Chinese stocks, and they all kind of feed into our process. And in terms of the process, because we have a kind of a 10-question framework, I would say, that all of our companies go through. So this is where we analyze everything from what's the market environment, what's the competitive advantage, like do they contribute to society in some way, what's the culture of this business, what's the financial strength, so we go through all these variables, and that's all of our companies, whether public or private, will go through that same process.
Yeah, thank you. And that's going to lead me on to talk to you about the private holdings in the portfolio. We've actually got a question on that, as you may expect. I know it's one that comes up a lot at your when you do investor forums. What are your thoughts on the level of private holdings within the portfolio? Lots of noise about this, and maybe you can talk a bit about that, about the private.
Yeah, sure. So as it stands at the moment, Scottish Mortgage has the ability to invest up to 30% in private companies. Now, just to maybe delve a little bit deeper into what that 30% means in practice, is that if we are below 30%, then we can buy new private companies or participate in follow-on funding rounds. If our holding goes above that 30% because of market movements or whatever reason, it doesn't make us forced sellers. What it means is we just cannot buy no more private companies, or we cannot participate in those funding rounds. And there's been points, during last year where we were above that 30% limit, maybe a third of the time, probably, maybe a little bit less than that. And during those periods, we cannot deploy further capital into private markets, but it doesn't make us forced sellers. And I think that's a really kind of important point to make. I think in terms of how we feel about the kind of breakdown of public privates, we think this is probably about right. But I put that in the context of the environment that we find ourselves today, because you have to take it one step back and actually ask yourself, why do we invest in private companies? Why do we do this? And the reason's very simple, is that companies are staying private for longer. If you think of the average age of a company that IPOs today, it's something like 20 years old. You go back 20 years ago, the average age of a company that IPO'd was something like 4 years. Now, why that's important is that means more value has been accrued in the private markets prior to these companies listing and going public. And we want to give our shareholders access to all that value that has been accrued in private markets. There's also a cultural element, I think. I think a lot of founders no longer have this same sort of feeling that there's like this coming of age moment when you ring the IPO bell in the New York Stock Exchange. I think companies and founders, they perhaps don't want the distraction of quarterly earnings cycles where you're held to account on EPS numbers and very, very short-term investors. And so a lot of our founders actually find it easier to stay on that long-term mission and vision in the private market. So there's kind of cultural reasons as well about why companies are staying private for longer. But from our perspective, as I say, we're at 30% today. If that was to change in any way, we would have to come to shareholders and ask their opinion on that. But as it stands at the moment, it's 30%. And I think we feel, reasonably happy with that breakdown with the private public split.
And there is a couple of things I just want to ask you just on the private market side. And I know this has had a lot of discussion and I'm sure you get a lot of questions on this anyway, but one is about valuations and valuating those holdings. Again, it's something the regulator has said very publicly it's looking at across, it's something they're looking at very closely. So I'd like to get your sort of your view on how that's done at Baillie Gifford and with the team there. And I suppose the other question as well is around, selecting holdings for that part of the portfolio. What in particular are you looking for, and what's the sort of risk management there with those companies? Yeah.
So I'll maybe start with the actual process, because I think it's something that we should be really proud of. I think we've got a really, really robust process around our private companies. And the reason that we think that's really important is that Scottish Mortgage is a daily traded stock, it's a daily traded company with a daily NAV. And we want to make sure that our NAV is as accurate as possible. So any changes that's made to our private company holdings is reflected in the NAV the very next day. There's no stale prices in our private companies. And that's quite different to a lot of other investment trusts or a lot of other funds that hold private equity, where you'll typically find either a quarterly or a 6-monthly lag with those valuations. And so I think that's really the first point, just to mention there. The other point, which is quite important, is from a governance perspective, which is that the managers, myself, have absolutely no input into the valuations of these private companies. We have a separate team within Baillie Gifford who analyse these companies. Sometimes recently felt like it's been on a daily basis. But we have a separate team that is completely detached from the Scottish Mortgage team, and we just find out the end result of those discussions. That internal Baillie Gifford team has a input, which is a third party, S&P Global. They input into our valuation process. So we have that third party looking at the valuations, looking at and giving us their suggestions as to what these companies should be held at. But then you have these other two layers on top of it, which is being a public listed company. We have a board, we have auditors. The auditors then check, our valuations, these private companies as well. But not only that, we also have the auditors of the other investment trusts within Baillie Gifford who also hold similar holdings. So if you take Scottish Mortgage, for example, we own SpaceX. Now, US Growth Trust owns SpaceX and Edinburgh Worldwide owns SpaceX. They'll have their auditors also looking at these valuations as well. So from that perspective, there is multiple layers of governance that goes into the valuations of these. And I think just to give you a sense of some numbers around this, just to give some proof points in terms of how on top of these valuations we are. I think in 2023, we hold 52 private companies, roughly speaking, I think at the moment. There was 450 individual revaluations of those companies. So 50% of those companies were revalued more than 5 times. That hopefully gives some confidence around that point I made earlier about not having those stale prices within the portfolio. And you can really see that. And we do give out those numbers in terms of how much we've marked those companies down by. And we give that every quarter, where you can see that we are happy to be transparent in that perspective as well.
Thank you for that. I've got a question here. Someone thanking you for the presentation and raising some issues. I know that obviously you focus a lot more from a stock perspective, but there's questions about what are the main risks that SMT see this year. You've got US presidential elections, UK elections, conflicts in the Middle East, global economic output, inflation. There's so many we could go on, and it is a very uncertain environment still for investors. But I don't know if you've got any thoughts, more recent thoughts on any of those. I suppose especially the US election and what impact that could have on particular companies.
Yeah, I mean, as it probably comes as no surprise that we probably don't spend much time actually trying to speculate on these issues, because as I probably alluded to within the presentation, what matters in our opinion over the long term is those kind of structural drivers of real change within industries. And so that's not to say that we ignore these events, but in our opinion, we're not experts in this field, and we don't actually think we can add any value or insight. And I don't actually think we would change anything in the portfolio, as a result of those variables. So I appreciate that's probably not a brilliant answer to the question, but it's, for us, a lot of our job is about blocking out the noise. There is just so much noise around everyone on a daily basis. And if you're trying to focus on the long term, where we find we get better sources of insights is from people that have the same time horizons that we do. We're not looking at things on a 6-monthly basis or a yearly basis. We're looking at what's going to change on a 5-10 year basis. And so we're much more likely to engage with academics who are looking at, how gene sequencing is evolving and looking at the impacts of artificial intelligence and, healthcare. And, these are the kind of people that we like to get our insights from and keep us focused on that long term. So that's probably where we spend more of our time and our efforts, is really thinking about those sorts of themes as opposed to, the short term, events.
Yeah, I suppose leading on from that, I did want to ask you about the current views on China and how that's impacting the portfolio. And you mentioned some of the companies there that where you're invested with exposure there. Perhaps you could just say a little bit about your thinking there.
Yeah, it's an interesting one because I think our thinking on China has evolved quite a lot last year, I would say. But I think as a starting point, I think it's important to say that when you talk about China, it's not a one size fits all. There's different companies experiencing different drivers, exposed to different risks and challenges. And so I think it's important not to just generalize, China from that perspective, And so from we were actually out there in May of last year. And I think it's really interesting when you go to these, you go kind of out with your normal day-to-day life and you just get a different perspective as to what's actually happening on the ground. I think that's really helpful from an investment perspective. But what I can say is that, if you go back to that very first thing that we said, Katrina, which was like, we're trying to identify and support the world's most exceptional growth companies. China is the largest economy or one of the largest economies in the world. And you have some of the most exceptional growth companies in the world, in this region, with some phenomenal founders behind these companies. And so, we have an obligation to look at these companies. We're trying to look for the best companies in the world, and China happens to be home to some of them. Now, what I can say from a Scottish Mortgage perspective is that, we probably halved our exposure to China over the last few years. If you look at where we were probably 2 years ago, we probably had about 25% of our portfolio in China. That's probably more like about 11-12% now, I think, just roughly speaking, looking at the end of year numbers. So what I can say is that, our exposure has roughly halved, but we've probably become a lot more selective on the types of companies we own in China. And what I mean by that is that particularly, like the beginning of last year or the tail end of 22, I think what we increasingly realized is that, we wanted the companies to be very well aligned with the government priorities. So we wanted our companies to be aligned with the themes that the government was very, very strong on. So whether that's on climate change and decarbonisation or sustainable technologies, or whether it's artificial intelligence, if you look at the companies that we have today, they are more aligned with those government objectives. So we have NIO, which is electric vehicle manufacturer in China. Again, that's helping drive that move towards electrification within the automotive fleet. I mentioned Pinduoduo, which is really trying to kind of improve profitability for agriculture and farmers in China. And we have companies, and they are bringing e-commerce to the parts of the Chinese ecosystem that Alibaba really didn't touch. Alibaba was mainly focused on the tier 1 cities. Pinduoduo helps the tier 2 and tier 3 in the rural parts of China that didn't benefit from e-commerce. So when you look at our China exposure, I think the companies that we have in China now are very well aligned to those objectives. And I think that we will continue to probably be quite selective going forward in the exposure that we have and make sure that they keep on that alignment path.
Thank you very much for that. That's really interesting to hear what you were saying there. Yeah, I just wanted to ask as well, the next thing I just wanted to ask was about, what you're saying about AI, which is all really interesting, as you know, is the big topic, a big area that everyone's been talking about, especially last year. And I was interested to hear what you were saying about how you've been hearing from academics and other sources around the development, because I think what we've been hearing recently is everything's moving so fast in this area. So I wondered if you could tell us a little bit more about how you're keeping up with the pace of change in this area. How do you know you're invested with the right companies that are really going to be driving this forward and benefiting here? And I suppose, what are the big things we need to be thinking about with AI next. This was last year was the big year where everyone found ChatGPT, and we sort of started to think about it. But yeah, how are you seeing that evolving going forwards?
Yeah, I mean, as you say, I mean, you saw that meaningful breakthrough, didn't you? With ChatGPT, you know, it signed up whatever it was, 100 million users in 2 months or something crazy like that. I think it'll probably come as no surprise, given our time horizons, that we're kind of acutely aware that we kind of need to take our time and analysing the implications. There's no need to jump to any conclusions in terms of what impact AI might have. We know it's going to transform many parts of the economy. I think it's very risky at this moment in time to make specific predictions. I think a lot of companies are kind of scrambling around, trying to understand the ecosystem that's developing around here, trying to work out who are the winners that may emerge, who's at risk. If you look at any earnings call from any CEO right now, like all of them are saying that AI is good for their business, which they are obviously going to do. But I think from our perspective, we're kind of wary about making kind of firm predictions at this moment in time in terms of how we, you know, how it might transform society. But I was on a call yesterday with one of our founders, and he gave this good analogy that we're only in mile 1 of a marathon in terms of what we think or what we know generative AI can do. And I thought that's quite a good way of framing where we are in this journey. To answer your question on sources, Katrina, I mean, we're very, very fortunate in Baillie Gifford and Scottish Mortgage that we have access to some of the most incredible minds within this space. And so, you know, back in October, you know, we were fortunate to go out to New York. We met with Jensen Huang, the founder and CEO of NVIDIA. You know, we spoke to him about, you know, what his views were, you know, talking about not just the competitive advantage that NVIDIA have today, but how does that develop? Where are the threats? Where do they see the innovation? Where it's, you know, all these sorts of things. We're very fortunate we get access to these people. And so that really helps us. You know, Jensen Huang has been the founder there for 30 years. When I talked about having those similar time horizons, it's really important, you know, that they know we're a long-term shareholder. You know, we've held NVIDIA since 2016. Again, coming back to what I said earlier, that's not been a smooth ride. There's been many bumps along the way with NVIDIA when we've held it. I think when I did the analysis last year, we had something like, in our holding period since 2016, we've had something like 16 periods where the share price has dropped more than 10%. I think the worst of which was 60-odd%, you know, a year and a half ago. But we've still held on to the shares because we believed in that long-term investment case. We believed in what they were doing with their chips, not just the hardware, but on the software part as well. And so I think access is important, and being able to speak to some of these minds of some of the founders and leaders of the companies that are right at the forefront of this paradigm shift.
Yeah, and I think it was interesting as well. You were talking about, obviously we talked about some of those companies directly tapping into this, but as you said, AI will affect every company now. So it's interesting for your other holdings to see how they're incorporating it and going to be changing with that as well.
Yeah, no, absolutely. And I think for me, I think it's healthcare. I mean, it's interesting. I was, you know, chatting to somebody last week, and I think that while everyone's sort of chatting about ChatGPT and, you know, you can make a poem which is Eminem mixed up with Shakespeare and send that, it's funny. Where I think is most interesting for AI is highlighting where it's going to have real value. You know, if this is about better diagnosing cancer or coronary heart disease or improving drug discovery, that's real life tangible impact that's having on people's lives. That's what's exciting for me. And so, yes, ChatGPT is a phenomenal tool and it's making people's life easier with whether it's writing content or whatever it may be. But I'm looking at it from the perspective of where is it having real value? And I think, and that's why in the healthcare, I mean, I probably could have talked about healthcare and AI for the whole hour if I was allowed to, but I think it's probably one of the most phenomenal shifts we're going to have in healthcare. And I think that's where we're really, really excited. And we have some companies in the portfolio who are right at the forefront of that intersection of, yes, say, technology and kind of biology, if you like.
I'm conscious of our time, but I've just a couple of other areas I just wanted to cover with you. Maybe you could just briefly just give us a little bit of an update on some of the recent changes to the portfolio.
Sure. So in terms of the transactions, Probably the most high-profile one of last year, the most high-profile new buy would be Meta platforms. So Facebook, which is probably more familiar to most people. Now, we held Facebook historically. We sold it a number of years ago, but we've decided to buy back in. And the reason for that is that to plagiarize Mark Zuckerberg's phrase is that, you know, Meta is essentially riding two technological waves. They're riding AI in the near term and the metaverse over the longer term. And so I think the reasons to invest in Meta at this moment in time is not just the revenue potential that comes from the progress being made in AI, it's also that kind of margin potential we talked about earlier about companies having much more attention on profitability and cash flow. And Meta is, you know, a very, very good example there. But if you take a step back and think about, you know, Meta platforms, you know, everyone is familiar with it in some way. There's what 3.5 billion of us use one of its family of 4 apps daily. So Facebook Blue, which is the classic Facebook, Instagram, Messenger, and WhatsApp are all under that kind of Meta umbrella. I think the last analysis I saw is that Meta reaches 70% of the connected population outside of China. So they're an advertiser's dream. You know, there's no surprise that advertising makes up the lion's share of their sales and profit. I think they account for about 20% of all digital advertising dollars in the US. But what we think is really exciting with Meta is that there's assets within there that are massively under monetized. If you think about WhatsApp or Messenger right now, these are two of the biggest messaging platforms in the world, but the revenues associated with them are kind of minuscule, really, when you think about it. And so where we are excited about with Meta is that kind of increased monetization of their estate. We think that utilizing AI is going to improve advertising. As I say, it can help facilitate commerce. If you think you're a small business and you have a AI chatbot behind it, you can engage with customers and help conversion. You know, we're really excited about all those things. And so that's probably the most high profile addition that we've made year to date. We've also bought a company, Coupang, which is a Korean e-commerce platform. We bought that in the latter part of the year. In terms of the main sales, I would say that, again, from a high profile perspective, Katrina, the high profile sale for us was probably Illumina. So Illumina is a company we've held in Scottish Mortgage since I think it was 2011. So we've held it for over a decade. So we've held it for a long time. And so for those that don't know, Illumina is essentially the world leader in gene sequencing technology. But for us, you know, there was a number of things with Illumina, excuse me, that just caused us to be a little bit more lukewarm on the investment case, which was really, we were seeing increased competition within the space. That was the first reason. So we were kind of worried about kind of the competitive environment around Illumina. They had also made a bit of a mess of an acquisition and as a result have destroyed quite a lot of shareholder capital. This was the reacquisition of Grail, which is the liquid biopsy company that they spun out but then bought back. They're now having to divest that for competition reasons. And then the third reason was they had, there's been quite a lot of upheaval, both within the board and within the management suite. So those sort of 3 reasons really led us to reduce Illumina, or sort of exit Illumina, I should say. So those are probably the more, there's obviously been some stuff around the fringes, but given we're long-term, turnover is pretty low generally. Those are the main ones that I would pull out.
Great, thanks for going through those. Yes, so just finally, again, I'm conscious of our time over lunch today. I just wondered if you could just give us a bit more information about where we are with discounts at the moment on the trust and any method you have to control the discount there, and a bit about gearing levels on the trust where you are at the moment.
Sure. Well, if anyone, I'm sure people on the call are aware of this, but in the latter part of the year, we saw the discount close quite substantially in Scottish Mortgage. It was probably sitting at quite a stubborn high double discount, kind of high teen double discount for the majority of the year. I think it sort of dipped about 22% discount in the summer of 23. That closed right in towards the end of the year, closer to 9%. You really saw a narrowing of the discount in the second half of 2023. And a lot of that is probably to do with the broader investment trust space as well. You saw the broad investment trust discounts tighten over that period. And that's after a period where the space has been on pretty, I think it was decade high discounts. It's been a space that has been pretty unloved, for a few years. So from our perspective, we're pleased discounts come in. We have been doing buybacks, and we think it's really important to be visible in the market when the trust is on a discount. So I think, roughly speaking, last year we did about 100 million worth of buybacks, Katrina, just across the board. So that's where we are today. Gearing as well has come down, over the year. We're kind of sitting roughly around 12% now. I think the average cost of debt of our trust is just shy of 3%. So again, I think we've been very good at kind of managing the not only just the levels of debt, but the cost of debt, and that kind of balance between long and short term, and the average cost has come down as well as a result of that.
Thank you. Thanks for updating us on that. Well, we are coming to the end of our session here. If you do have any more questions for Claire and the team, then please do get in touch with Baillie Gifford after this, and I'm sure they'll be very happy to answer those. Really interesting talking to you, Claire. I think, as you said, any of those topics we could have done a whole session on, but it gave us a really good overview, especially at the start of the year, for some of those key areas to look at, and some really exciting opportunities there. Just before we close, I'd just like to take a quick look at those learning objectives again. So at the conclusion of this session, delegates will discover what the unique philosophy is sits at the heart of Scottish Mortgage, why long-term structural changes in society are more powerful drivers of change and disruption than macroeconomic or geopolitical issues, and why it is rational to seek out the exceptional companies driving this change to maximise your chances for growth over decades. And finally, why the current environment leaves room for optimism for investors willing to take a long-term patient view. And as we said earlier, you should also receive your CPD proof of attendance over email in the next 48 hours. I'd also, just before we close, like to leave you with just some information about what's to come from professional advisor events as we launch into a busy first quarter. Next week, we're back on the road again for our traditional Q1 multi-asset roadshow. We're going to be joined by speakers from Bordier, Denton's, Morningstar Investments, Orbis and Schroders. I've got a keynote speaker for the roadshow, which will be Morningstar Head of Research, Jonathan Miller. The dates and destinations for the roadshow should be on the slide in front of you, but on Tuesday, the 23rd of January, we'll be at a new venue for PA, the impressive Alton Hall near Leeds. On the 24th, you'll find us in Warrington, and on the 25th at the National Conference Centre in Birmingham. And the following week, we'll be in Bristol on the 31st of January and finishing up in London on the 1st of February. And if you're watching this session, you're anywhere near Glasgow, Chester, Cardiff or Aylesbury, you should expect an invitation to one of our 4 regional working lunches with Orbis. These offer a fabulous 3-course lunch in a great setting near you. So our principal sponsor there, Orbis, will be discussing the importance of a truly diversified portfolio. And then on the 6th of March, we'll be back with Baillie Gifford's next online working lunch, and we'll be announcing details of their speaker and the topic they're going to be covering in the next couple of weeks. And just away from conferences, on the 20th of March, we're celebrating the very best in our industry with the annual Professional Advisor Awards in London. So if you want to come along and rub shoulders with our winners, there's still 1 or 2 tables remaining. So that's a total of 6 hours CPD over the next few weeks, and a big night out there celebrating the best in the industry. So as ever, if you wish to find more information or sign up to any of our events, you can do so by visiting the website professionaladvisor.com/events. So that's it for today's session. All that remains is for me to thank Claire. Thanks so much again for your presentation, answering our questions. And as ever, our greatest thanks go to you, our audience, for your company this lunchtime. We really hope you found the session helpful, and we hope to see you again at another professional advisor event very soon. So goodbye and